What is a portfolio loan? And if you're asking that question, if you're searching for that answer, what that tells me is you're making some big moves in your business and you're really looking to step it up. A portfolio loan can be an invaluable tool for any business owner, any entrepreneur, especially if you're a real estate investor that's ready to take it to the next level. And I'm gonna break it all down for you right now. Let's go. I'm gonna go over the what, when, and how of a portfolio loan, the pros and cons of a portfolio loan, and then if you decide that a portfolio loan makes sense for your business and you right now, I'm gonna show you how and where to get one. So what is it in the first place? Well, a portfolio loan is a loan that a lender or a bank will originate where they have no intention, or really they don't have the ability to offload it on the secondary market. They're going to keep it in-house. The lender gets to set the standards. They get to call the shots, and sometimes very favorably for the borrower. 2, when can a portfolio loan be used? Individuals might use a portfolio loan for the following reasons. 1, to gift or loan money to their children. 2, to invest in a business. 3, to purchase a luxury item. 4, to refinance existing borrowing, or 5, to reinvest back into their investment portfolio. What we use it for around here most is to purchase investment property. And that could be commercial, residential, any type of investment property. Portfolio loans, in our instance, are especially useful when real estate investors max out their mortgages. For most traditional lending institutions, the maximum mortgages a borrower can have are 4 real estate mortgages. Generally, with good credit and good down payments, a borrower can finance up to 4 properties. There are even circumstances in which a lender may give out more than 4 mortgages, where a borrower can get more than 4 properties through financing. In 2009, Fannie Mae raised the limits to 10 mortgages. But there are specific situations or requirements that need to be met, of which makes this unattainable for most people, makes them kind of rare to obtain. But still, we have clients at Cashflow Savvy that max out their loans all the time. Whether they get 4 or 10, they max them out all the time. So what is a real estate investor to do when they find themselves in that situation? Are they just to stop investing? No, because in steps the use of a portfolio loan. That enables a real estate investor to continue investing using financing. And what they'll do is they'll consolidate those 4 mortgages that they have with the traditional lending institutions, or the 10, whatever it may be. They'll consolidate that into a portfolio loan, therefore wiping out their minimums at the financial institutions, at the banks, and they can start all over again. So they can start from scratch and go for another 4 or another 10 loans and continue the process over and over and over again. So that's one huge advantage of using a portfolio loan for real estate investors. But what are other potential benefits of using a portfolio loan other than liquidating investments? A portfolio loan could allow a real estate investor to access additional funds without triggering any tax activity, without being responsible for any sort of taxes on the gains that they got from those original ones. Because what happens is the IRS, they don't tax borrowed money. Further, if you don't have to sell the property in order to acquire other loans, you can keep your yield working on multiple properties. Should you have a funding need, by borrowing against your portfolio rather than withdrawing from it, it leaves your portfolio intact, thereby potentially benefiting from upward market movement. Your portfolio in its entirety continues to perform and produce you a yield. With interest rates at historic lows, many borrowers are considering this a very good time to borrow. Portfolio loans, they can be very easy to arrange, and there are typically no prepayment penalties. So how do they work? How does this whole process work? Portfolio loan standards can really differ from your government-backed loans, like your Freddie Mac and your Fannie Mae loans, of which if the borrower has any sort of issues inside of their credit history or payment history that can easily be explained away, you're going to find a lot more flexibility there, a lot more flexibility than you would find with government-backed loans. The benefits may include the loan doesn't have to meet any conforming limits. The lender can set any down payment amount that they want, and then there's private mortgage insurance that you could avoid, even if you're making a really small down payment. Don't have to deal with that anymore. Portfolio loan can be really attractive to borrowers in many situations. Let's say that a period of bad luck has really kind of pushed down your credit score. Maybe you've had a few months of low income or unemployment, or maybe both. Financial hits like that, they don't look good on paper, so you can really take a hit and it could inhibit your ability to get a traditional mortgage. But if you have a history of solid credit and consistent payments otherwise, your banks might overlook that and give you the portfolio loan anyway. Essentially, a portfolio loan gives you access to more flexible underwriting. If you own a local business, if you're a doctor or a lawyer, a bank may also give you a special deal via a portfolio loan. Why would they do that? Well, if you're a local business, the banks would like to foster that relationship with you and do further business with you, so they're going to treat you a little bit more favorably. It's in their best interest. You see, for the bank, it's a way for them to generate more business, and it could position themselves in a way that they could offer you your next mortgage loan or your next refinance. It just means more business for everybody. Portfolio loans, however, they are rare. You see, typically when a bank makes a loan for a property to one of their clients, they'll take that loan and then they'll go sell it on the secondary market to increase the liquidity, to increase the cash flow of the bank. That's how it's normally done. And because of this, portfolio loans typically will go to the bank's best customers, the customers that are most likely to pay that loan back, the ones that are most likely to generate future business for the bank. Still, whoever the borrower is, the bank can't just issue out blank checks. The loan still must meet the bank's internal requirements, in the sense that they have to find borrowers that can prove their credit worthiness, they can prove they can pay the loan back without the bank taking on any unnecessary or over-the-top risks. Sounds pretty good, right? Well, these loans still, they're not for everybody, and I'm going to talk about the cons of a portfolio loan. And before I break these down for you, if you're really interested in your real estate investing, if you're really taking it seriously, you might want to click the subscribe button, because I post cool stuff like this each and every week, multiple times a week, on how to make money, how to maximize your ROI, how to minimize your risks, how to really level up your real estate. And I don't want you to miss any of that. So go ahead and click the subscribe button. So the cons of a portfolio loan, they can be potentially higher fees, potentially higher interest rates. They can come with prepayment penalties, so you want to keep your eye on all three of those. And they might even have a shorter or a less convenient payment schedule or repayment schedule. Not really that big of a deal though. I mean, if what you're using the money for brings you back enough income to pay for all of those fees, then it kind of makes sense anyway. So now, if it does indeed make sense for you and your business or whatever you plan on using this loan for, where do you get one? Because banks, they don't really advertise these. You're not gonna find them in the paper, you're not gonna find a TV commercial or a radio commercial. They really reserve them for their best customers so they can generate future business. They can create relationships with local businesses, with local professionals to generate future business for themselves. Even so, you should shop around. Don't take the first one that's presented to you. Shop around, go from bank to bank in your local community and see if you can have them give you what their portfolio loan requirements, what their guidelines, what their terms are. One of the best ways to increase your chance of getting a portfolio loan and getting access to these preferred loans is to make sure that your checking account, your business account, your savings account, maybe your retirement account are all with that bank. That makes you a preferred customer, so likely you're the type of customer that they're going to want to reward and work with on these portfolio loans. Or if you're looking for a portfolio loan specifically for your real estate investments, it might make sense for you to reach out to Mercedes. You can download her free investors packet at cashflowsavvy.com. And there, after you've done that, you'll have the opportunity to pick a time to hop on the phone with Mercedes and kind of brainstorm some ideas about what's the best type of financing to keep your portfolio growing. It might even make sense to go ahead and take a look at her inventory. There might be something there that you want as well. And that process can begin at cashflowsavvy.com. You can type that into your browser, or I'll go ahead and I'll put a link down below in the description for you for your convenience. Alrighty, that's it. Thanks for watching. I'll see you soon. Take care.